Hello and welcome to our series of AGM presentations. In January this year, Amati was 10 years old. We had our 10th anniversary celebrations and everything seemed to be going fine. There was a sort of little regarded but conscious event going on in China around a novel coronavirus, which is being much discussed, but conventional wisdom at the time seemed to be that past viruses of a similar type hadn't really spread very much. It was being taken care of over there. There was a severe lockdown going on. But in general, people in this country were not panicking. And that was, we were ourselves planning a big celebration for our 10th anniversary AGM. And we were really looking forward to being with you all in our customary venue, which for those of you who haven't been before, over the last few years, we've cultivated quite a big event, an elaborate event at the Guildhall School of Music and Drama in London, who we collaborate with. We host a rather unique event with them, which we call the Amati Guildhall Creative Entrepreneurs Award, when we celebrate the achievements of participants in the Guildhall's own Creative Entrepreneurs course. And we hold a little competition for them, but really it's a showcase and we're celebrating their achievements. And as a result, we hold our AGM in the wonderful setting of either the Milton Court Theatre or one of the studios around that. And that's been very exciting, and we were planning all sorts of great events. And then along came a rather rude interruption to our plans, and I'm sure this has impacted many of you. We've had to abandon our customary experiences, and we're locked in. And very sadly, we had to take the decision to not hold a public AGM event. And the AGM itself is really restricted to just business formalities. I don't think there's anything incredibly controversial to vote about. And fortunately, we've had very good support from shareholders. But we love talking to you, and we love meeting you and hearing your questions and responding to them. And we love to showcase what we've got in this VCT. So we've had to go online, and me talking to a camera is the best we're going to get this year. And clearly we look forward to more personal contact in the future. So what have we got set on our web pages for you? I'm going to make a few introductory remarks. And my colleague David Stevenson has prepared a more detailed presentation on the portfolio itself, the winners and losers, its characteristics, the kind of things we've been doing, which I hope you'll find interesting. And in addition, as again, many of you will know, we've often invited a couple of companies along to our event in the Guildhall so that you can hear from them directly. And we thought rather than forego the opportunity to do that, we'll go one step further. And between us as a team, we've interviewed actually 6 of the portfolio companies, and really to give you the flavour of them and to allow you to meet some of their management, the key managers personally. Well, not quite personally, but via a Zoom interview. But the idea of it is twofold, really. One is to help you understand the companies in the portfolio, to give you a better idea of what they do, and more specifically the character of what they do and how they run, what they're trying to achieve, the sort of challenges they face, something of their history and so on. But equally, we're also wanting by doing this to underline the fact that one of the characteristics of managing the VCT, which I personally, and I'm sure that's true of my colleagues too, really love, is the fact that the kind of work we do is really face-to-face investment. And I think this is actually something that's very important in financial services generally, not to lose track of. You know, for me, financial services, the financial markets, I should say, financial markets become a little bit perilous when we lose this face-to-face quality. You know, for us, the portfolio is really not numbers on a screen. It's a series of relationships with specific companies that we've cultivated over many years. And I suppose these interviews are really designed to give you, our investors, a flavour of that so you can share in it, because really we want to shorten as much as possible the gap between you, our end investors, and the companies that you're investing in through us and through this VCT. And we like to keep hold of both parts of that equation are of huge importance to us. You, our investors, we make sure that we try to make sure that we never forget your interests and that we represent them adequately. But then on the other hand, the companies that we're backing and the difference that your investment in them makes. So hopefully you can get something of the flavour of that, and I hope you will feel as proud as we are of many of these companies and what they've achieved over the years since we made the investments. So the companies that we have chosen to go with, there's Frontier Developments, which we first invested in May 2013. There's Learning Technologies, which was invested in July 2015. GB Group, which actually we go all the way back to September 2010, our first investment in that from the VCT. It was pretty much soon after Amati began. Ilika, where actually one of the VCTs that we took over, Invesco Perpetual AIM VCT, we took over the management contract of that in 2011. But that VCT itself in May 2010 made an investment in Ilika, which we inherited. And then we made our own small investment in that in 2014. And as you'll have picked up from our more recent literature, and I'll come back to this, we made a much bigger investment in that company actually earlier this year. So it's now a substantial holding in the portfolio. And there's Ixico, which our first investment was more recent. It was May 2018. And finally, Polarian, the most recent of these investments, July 2018. And then finally, we have a video at the end from, which I hope you'll enjoy and watch, from the winner of last year's Amati Hillsville Creative Entrepreneurs Award, Mark Evans of ABC of Opera. Now Mark is just a remarkable creative entrepreneur. It was such a pleasure to be able to support him through the award. And we took the decision earlier this year, really recognising how much many artistic ventures such as Mark's have been set back by the coronavirus lockdown. In many ways, the arts have probably been the hardest hit sector of all. It's certainly something very much on my mind. We took the decision that we would, instead of just not holding the award this year, we would not be able to hold a new showcase, but we'd look again to support Mark. So we used this year's prize money to actually sponsor a project that was very important to Mark and ABC of Opera, and you can hear about that by watching his video. That's one thing that I customarily do when I get to do a few remarks at our AGM, is I talk through what I call our sort of animation of bubble graphs, and this allows me to look back a little bit. It's a bit nostalgic, but it also brings you up to date with probably the single most important feature of the portfolio as it's evolved over the last 10 years, and that's the way it's matured. And I'd say, looking back over this 10-year period, probably our most important decision that came from experience, and we took this pretty firmly around 5 years ago, consciously, was to run the winners in the portfolio. And it's one of the features of an AIM VCT that we're really under no massive pressure to exit holdings, and especially holdings which we recognise have done what we expected of them and have become very successful businesses. And there's little in the way of limitation on how long we can continue to support those companies for. And so it very much reflects our mentality when we make a new investment. Our whole idea is to identify investments that are going to be suitable for hanging on to for 10 years, 20 years, maybe even longer. So we see ourselves as being in this for the very long term. And having taken that decision and decided to run the winners, the following has happened. So if we look at this first bubble graph here from February 2012, what we're plotting on this graph is the size of the bubble represents the size of the holding in the portfolio. At the bottom, you'll see dates, and those represent the year of first investment in those companies. And on the left, you can see the market capitalization. And the market capitalization is the valuation that the market puts on the company. If you add up the value of all of the shares of that business, that's what the market thinks it's worth. And as you can see, back in 2012, we actually thought we were doing quite well then. We had a couple of companies, we had a few companies over £100 million in value. That seemed like a lot. And we had many companies over 50 million. And we thought within the confines of the rules under which we make new investments, this was not too bad. And then if we wind on to 2015, you can see a lot's changed over this 3-year period. We now have a number of companies over 200 million in value, many companies over 100, even more over 50. Wind on again, February 2017. Now you can really begin to see the portfolio maturing here. We have 3 or 4 companies at around 400 million in market cap, a good number beyond that over 200 million, many more over 100, and so on. And as you can see, the holdings which are the biggest are almost by definition the most successful. And so this is really the virtue of running winners, that you then place the most emphasis in the portfolio on the best companies, the ones which are achieving the most and becoming the most valuable businesses. So let's wind on again. May 2018. This is, I have to say, pretty close now to the top of the AIM market, which peaked in September 2018 and has come away a little bit since then. But you can see here we have a couple of businesses over £1 billion in value. That's a real landmark for the maturity of the portfolio. Several others over 500 million. And really now it's commonplace for businesses to be valued at more than 100 or 200 million. And if you look at the weightings again, you can see that very definitely the biggest holdings in the portfolio are also tending to be the largest companies, and those that have achieved the most. And then let's wind forward again. This is where we sit. Today, 22nd of May 2020. So this is pretty recent. We're trying to name the companies on the portfolio here. And really the ones which are named are the top 10 holdings. And you can see broadly the pattern is actually fairly similar to where in May 2018. But there have been a couple of important changes. And the couple of important changes are some new holdings, these 2 here, Ixco and Polarium, which you can see better on the next slide, where because they're hidden behind other bubbles, we sort of x-ray the other bubbles on the next slide so you can see them better. And we now have in the top 10 holdings actually 2 holdings from more recent investments. I think this is quite an important development, where we're starting to see some of the holdings that we've made investments in since the rule changes, under the new, more restricted set of rules, which effectively force us to take more risk than we would otherwise have had to have done under the older rules. And I think most VCT managers, and ourselves included, have really embraced this set of new rules and run with the challenge. And of course, what it does do is it very much pushes us towards pretty technologically sophisticated companies, those with high amounts of IP, those which are very knowledge intensive, have become much more, they were always there in the portfolio, but they've become even more commonplace. And of course, we've seen a very significant growth in the healthcare sector representation in the portfolio since the rule changes. And I suppose that's really reflecting a couple of things, actually. It's one, the rule changes mean that we're more likely to see deals from that sector. It's a very cash-hungry sector, as I'm sure many of you will know. But also, it's one where strategically we've run with it and we've sort of embraced it as an idea, because we had the thought back in 2018 that this sector was, if you like, the new, what one might call the new industrial revolution is going on in healthcare. And there are so many new technologies coming to fruition. It's taken a very long time to get here. I've followed some medical technologies that are developing over 20 years, and some of them are still not there yet. But there's a number of really important technological advances in medicine which now are becoming commercial, and we see this as a really big landmark. And so it's gone from being, I think, probably the most difficult sector to invest in to being just simply difficult. I'm not saying it's easy, but there are some really good investment opportunities, we think, in the sector that are appearing on the AIM market. And as we think we've got a number of good representatives of them actually in the portfolio. There's a couple here, Polarian and Echo, both of which you can hear interviews of in the videos to follow. Then I thought it'd be interesting to also just consider a little bit the rate of qualifying investment that we've been able to make. And clearly this has been impacted by successive rule changes. Actually from 2016 to 19, the rules around what we could invest in changed significantly and regularly. I'm reasonably confident now that the rule changes are substantially done, and we're not really expecting further rule changes of substance. So we think we can now sort of settle in for a longer period of stability in a way that work. But that did impact and has made a big impact on the rate at which qualifying investments have been appearing on the AIM market. And again, David's going to talk in his presentation a bit more about the sort of level of what we call deal flow. And by deal flow, we mean the number of investment opportunities arising for us to make qualifying investments into companies. And remember, qualifying investments are always only happening when companies raise money. So they always represent moments when new money is going into a company for a particular project. And under the new rules, that those projects have to be for the purposes of growth. There's a entirely separate test which looks at, is this company going to use this money in order to grow its business? And it's a reasonable thing to ask. And it's one of the core reasons why the government is keen to sustain the kind of tax breaks that we enjoy in the VCT and the EIS investors enjoy too, is to enable the growth part of our economy to grow and to have the resources to do that, to scale up. But they want to make sure that the money is going to allow businesses to grow. So it's a separate test. And so what we've done on this slide is just look at half year by half year over the last 3.5 years, how much new qualifying investment have we made over each period. And as you can see, it's been actually a little bit 6 months on 6 months, a little bit unpredictable. Although if we look at the last 3 years as a total, it's been actually pretty consistent. But we've had some big variations. So for example, if we look at the early part of 2019, which is here the first half of our financial year 2020, which is the bar represented by 9.8 million, you can see that was a very strong year for new investment. But the second half, we hardly did any new investment, only £1.2 million, which is very low. And I would say that I think what happened in that second half of last year was just the incredibly high level of uncertainty. It seems like a distant memory now, but if you cast your mind back, you'll remember that from really June onwards last year, the country was paralysed by a sort of parliamentary deadlock over Brexit and huge uncertainty over a general election, whether there was going to be one, whether there'd be a change of government. If there was a change of government, would it be to a very far left Labour government who might completely change our economy fundamentally? And so it's not too surprising actually that not many new growth initiatives were being taken at that point, and everything seemed to go on hold. And then actually interestingly, and this is really the reason for putting this graph up, what's happened in the first part of this year, as those of you who study our fact sheets will know, is that actually we were making new investments really very rapidly, probably at a faster rate than we've ever done before, not massively faster, but a little bit faster. And what was going on here was really, we saw a couple of new investment opportunities, but primarily what we were doing was we were increasing holdings in certain key portfolio companies where we thought they have really good opportunities. And actually we had at the back of our minds earmarked that these companies might raise capital in the future, probably would need more money, and that we were interested in backing them and increasing our holdings in them if they did so. So if you have a look at the next graph here, what we're showing here really is the split of these levels of qualifying investment according to how many were follow-on deals and how many were initial deals where we're making the very first investment in companies. And actually what this shows is that you'll see the second half of our financial year 2018, first half of 19, saw more new initial deals than we've done for a while. And actually the last 12 months have really been a little bit sparse in terms of new deals coming through. And I think that's primarily, as I said, it's the sort of paralysis we had last year. And this year, we haven't seen much in the way of new companies coming to market. And again, I think that's because it actually takes quite a long time to recover from the sort of IPO paralysis we had last year. IPOs take a long time to plan, they're very expensive, and you need a confidence and predictability to do them. So of course, with the COVID-19 pandemic crisis that we've been through, that's, I think, probably pushed out deals a little bit further, hopefully into later this year rather than further than that. But it meant that the number of news in the first half was relatively low, but we really did a lot of investing into our existing portfolio. And what that's meant is that actually our existing portfolio companies, those that we think are key holdings, are now really outstandingly well funded. And actually in every case when we were making these new investments, and these are into companies like Polarian, which you'll see interviewed later, and other holdings, Diurnal, and I won't go through them all, but Ilika, which we've also interviewed. What each of these companies found, and this I found interesting, was that when they came to raise money, and we were sort of half expecting them, so our decision wasn't too difficult. But each of these companies ended up raising much more money than they thought they were going to, and actually tending to be at better prices than they thought they were going to be able to do as well. And the demand for these investments, actually from VCT EIS investors and from non-tax-driven investors, was really significant. And actually it's one of our rules of thumb is that we really like to make new investments where we're also investing alongside non-tax-driven investors. It's a way, it almost sort of validates deals, it validates pricing, and it gives us more confidence that when tax-driven investors can't make any more investment in the company, then other investors are going to be there to step in and take up the baton, if you like, in terms of financing these businesses. So I think it's left the portfolio in very good shape. Actually, this high level of financing for existing companies, it's meant also that some of the newer holdings in the portfolio have become much more significant holdings for the VCT, as we saw from the bubble graphs, and hopefully they will be significant contributors to performance over the next couple of years. And I hope we'll be reporting on good news from them in the years to come. Finally, I think it might just be worth saying one or two things more about the crisis that we've been through. Clearly, we've been through a flash crash, if you like. It's been so fast and so far-reaching. The numbers that we've been seeing in every possible dimension, whether that's unemployment or business rescue money, government bailouts, quantitative easing, the kind of numbers that we've been talking about have been bigger than we've ever really contemplated before. And there's so much going on in such a short space of time that it's very difficult really has been difficult to stop and reflect on what's been going on. And I've spoken a couple of times about the sort of 5 phases of a market crisis. And normally a market crisis, these 5 phases are dragged out over perhaps a couple of years, at least a year or maybe 2. And so the first phase is really when you see the storm clouds building in the distance and you wonder, is this going to affect us or not? And there isn't really enough evidence to be completely sure that they're going to affect you, but you worry a bit that they might, and your risk sort of antenna go up. And I'd say that's where we were in January, February time, particularly when we started to see the virus spreading to countries outside of China. And then there's the second phase, which is the most stressful in many ways, when you have, which I call going over the cliff edge, when really the crisis hits. and it becomes abundantly clear that yes, the crisis was real, and yes, it is going to affect us, and you kind of have to rethink everything. And of course, it's not possible to rethink everything fast enough. So the market kind of goes into this phase of free fall, phase of huge volatility. You get dramatic moves, and they're reported in the news. In the morning, you wake up and you're being told, oh, the Asian markets are down 8% overnight, and you think, okay, I know what's going to happen here. And they're swinging around, and you get some very, very extreme moves in individual companies. And when that phase has sort of taken place, and it's never clear when that's over, but you go into this mad, what they call dash for analysis, when your fund managers like us and investors everywhere around the world are desperately trying to analyze everything we can get our hands on as quickly as possible to make sense of which stocks represent buying opportunities, which ones look dangerous, what kind of strategy is going to work, how should we position portfolios. And of course, the huge danger in all of this is that you just do far too much, and everything feels like a call to action, and every major price move feels like you need to do something about it. When, naturally enough, very often the right answer is to do nothing at all, because there isn't much you can do. But there's this dash for analysis, and again, this is quite a stressful period, because there simply isn't enough information to go around, and it's incredibly difficult to form any kind of hard conclusions. You're having to rely a lot on instincts. You're having to, if you like, integrate vast amounts of data and try and come up with some kind of meaningful views. And that phase then feeds into the next phase, which I sort of call recalibration, when the market has better information and you begin to get more of a consensus forming about what might happen and what the real implications are going to be for businesses. And if you like, this appears through something of a more some stability returning to the market. The market beginning to play its price setting role more accurately. And remember that the market, if you like, at this point begins to represent the wisdom of crowds better. And there is a phrase which is the market is never wrong. Well, in that panicky phase, the market is normally wrong. It's just you don't know how it's wrong. When you go into this recalibration phase, it begins to find its equilibrium again, if you like, and what it's saying becomes really important. And actually, what we've seen over the last few weeks has surprised many people. We've seen a really significant recovery in markets, and actually the net asset value of the portfolio in the VCT, having when we started the year, or when we ended the financial year, as you'll see in the annual report, it was around 156p net asset value. At its low I think the intraday low at the bottom of the panicky series of this crash, I think it hit a low of about 109p, not for very long. And now I'm very happy to say it's back over 150p again. It's made a really pretty incredible recovery. And actually the recovery in stock markets generally has in some ways frustrated lots of commentators and surprised many commentators on markets, because we're looking at incredibly bad headlines in many ways. With the potential for massively increased unemployment in the US. Unemployment is now at levels similar to the Great Depression. Unemployment is much lower in Europe, where we've had furloughing schemes, but none of us know how high it's going to rise when the furloughing schemes end. Government debt clearly has skyrocketed in mature markets. We don't really know yet what the implications of that are. And yet stock markets have gone up. So some people are a little bit puzzled by this. And I think it's worth saying something about that and what a possible counterbalancing argument might be for that, which I think is worth bearing in mind if you're contemplating what's going on and wondering what might happen next. And really, I think the most important thing to say is that what we've seen over the last, in response to the lockdowns, has been an astonishing increase in the money supply. both in Europe and in the US, and actually many other countries of the world, where governments have made the decision to put in place bailouts. Money supply has been rising at probably its fastest rate in living memory. And the other side of that is quantitative easing, where governments have been expanding central bank balance sheets to create money, and they've been pushing it out into the economy. And that kind of increase in the money supply would very rarely go along with a falling market. And so while you may have some lots of troubling headlines in terms of traditional economic metrics, with such a strong increase in the money supply, it feels unlikely that that's going to find its expression actually in a falling market. And I suppose the implication of that is that the way out of the crisis, the way out, if you like, of the huge rise in government debt is not going to be austerity next time around, or this time around. It feels unlikely to me that politically that's going to be acceptable in many developed markets, and I don't see any politicians rushing to build their franchise on the back of a sort of responsible reduction in debt levels involving lots of belt tightening. And so, the only other way, the only other way through this, the only other way to reduce, if you like, the government debt to GDP ratios is logically inflation. And so the high level of increase in money supply for me is more likely to result, and this I should say this is my personal view, this is not necessarily Amati's view, we don't fully agree on this as a team, so I'm just giving you my own thoughts. But I think this is more likely to result in inflation than it is to result in a falling market. And I think that's really why we've started to see markets firming up the way they have. I see that as an indicator of that sort of that outlook. Whether or not you should take comfort from that, I don't know, because the problem with inflation reinserting itself, and I can't say when that's going to happen. But the problem with it's going to be that for most of us, living with significantly higher levels of inflation is really going to be a new experience, and we're going to have to really stretch our memories and dust off our textbooks and recalibrate, if you like, to figure out how does that affect each economy, and how does that affect the corporate landscape and the commercial landscape. But I think it's worth passing on that thought to you, so that you don't necessarily conclude from some very negative economic headlines that therefore means the stock market's going to fall. It doesn't necessarily mean that. There are other ways that this gets worked out, and one of those is inflation, and whatever that brings. I think the other sort of big picture thought, maybe to leave you with, and this is maybe less positive. I've talked in past years about some big picture thoughts on the kind of industrial revolutions that we've been through, and if you like, try to explain the very substantial success of technology investments and of the kind of investments we've seen in the VCT over this 10-year period as representative of a golden age in this industrial technology revolution that involves digital technology, the implementation and commercialization of digital technology. And that's not finished. And fortunately, and it's one reason why we are very keen on running the winners. The winning stocks we got in our portfolio are mostly implementers of digital technology, and very effective ones at that. And they're now of significant substance, and they've got the wherewithal to carry on being successful in that kind of industrial trend and to make more of it. And it's not finished. I do personally think it's going to get more difficult now for startup companies coming in to try and do the same thing. I think many doors have bolted behind these companies that we've seen, and it's harder to be successful trying to play the same game again. And that's normally how markets work. And so if you like, I think that particular golden age when you could start new things very easily 10 years ago and expect to be very successful, that's now coming to an end. And it's going to be, I think it's going to be more about companies which have already been successful continuing to do what they do over the next period to come. But if you like, there's a new sort of, and for me, less palatable trend that I hope doesn't become dominant, but I fear may be, and we're already beginning to see the glimpses of it through this crisis. And a lot of people have said, actually, one thing that the COVID-19 crisis has done is it's accelerated trends that were already in place. And I think that's very true. So in stock markets, you can see that actually healthcare stocks have really outperformed most other sectors. And a little bit, like I was saying earlier, healthcare, I think, is a big new industrial trend that's going to emerge and have its own golden age over the coming 10, 20 years. But equally, there's another trend going on, which is what one might call a geopolitical trend. And this is good documentation of this. The trend I'm referring to really is the changing relative size of the world superpowers. And very clearly the post-war period really has been very much dominated by the US as the most significant superpower in the world. It's been the chief innovator in the world. It's no accident that the biggest technology companies have been US companies. What we call the FANG stocks, as they're regarded. What I'm talking about. The very largest companies on NASDAQ, whether you say there's 4 of them or 5 of them or 10 of them. The largest and most successful implementers of digital technology are all US companies. And that's no accident. And the US has been the dominant superpower. What we're now seeing is a very significant acceleration of China, to the point where now many people predict at some point, maybe it's 2030, maybe it's later, we start to see the possibility of a crossover point. And actually that crossover point holds many, many dangers for all of us. That there have been very few precedents in history when a dominant superpower has been overtaken by another one and it's gone smoothly. And so I think we need to be attuned to that. It's clearly problematic. It's mainly problematic because China is not a free country. It's a political system under which few of us would really want to live. There are many reasons to be wary of China. There are also many reasons to admire China. And of course, one of the dangers we're in living in England or whatever country we might be, whether in the West, is that we only ever hear one story about China, and that story tends to be negative. And I had the great privilege of going to China myself in 2007 on a research trip. And I deliberately went there because I recognized the importance of the country and I wanted to get a better understanding of it, and went to visit companies in China, and it was a week-long trip. And at the time, China was listing quite a few companies on AIM, and I wanted to find out more. And actually one of the companies that I went to see in Shenzhen was at the time a not very well-known company called Huawei, and I visited their headquarters. And I have to say I was completely bowled over by Huawei. And those people who tell you this is an amazing company, listen to them, because it is a completely awesome company. And clearly it has extraordinary capabilities. And it was already very clear in 2007 that this was going to become a major world-beating technology business. And one of the indicators at the time was that they told me, and we managed to have a translated conversation with some of their senior managers. They had an R&D department back then of 50,000 strong, 50,000, mainly PhD students, of whom perhaps 2,000 or 3,000 were in outside of China, mainly in the US. And they would get 1 million job applicants a year from within China. And as you know, China produces more PhD candidates and successful candidates than the rest of the world put together. So what I picked up was the research capability in China was unbelievable. And most of my time that week was just looking at things, thinking, where did this come from, and how did I underestimate it so much? And this was 13 years ago, and now it appears America has a huge problem with Huawei because Huawei has become the dominant provider of 5G infrastructure. And, it's not surprising that we're seeing, anti-competitive behavior mixed with fear in the response. And I think this is, that particular conflict and the trade war that's being started around Huawei is indicative of a much bigger crisis to come. And it's a crisis that's really representative of this crossing over of superpowers. I can't give you a crystal ball to say how this is all going to play out. I do think it's something we need to pay a lot of attention to. I would love to think that China will rise to its position and do so as it is quite capable of doing gracefully and doing so humanely. I'm wary myself of only ever hearing one story about China. I don't want to do that. I want to make sure I listen to the multiplicity of stories that come out of what is a great country. But it's clearly something we need to pay a lot of attention to, and we should all do whatever we can to make sure that transition and what is to come is peaceful. So with that thought, I will leave you to watch some of the other videos on our website. I hope you're pleased with your investment in the VCT. Please do send us your questions. We didn't have very many questions coming in from our invitation to ask questions for the AGM. We are very happy to answer follow-up questions and other things that may have on your mind. Please do always feel free to contact us with questions, and we try to be as responsive and personal as we can be in the way that we answer them. And I very much hope you enjoy the other videos that we prepared for you. With that, thank you very much for your continued support.